If you're ready to begin investing, then the first step to building a new portfolio is to open a brokerage account. And the reason why you need a brokerage account, even if you don't want or need the advice of a broker per se, is because you need someone or some firm to actually execute orders on your behalf. And these orders are orders to buy and sell stocks, bonds, mutual funds, ETFs, and all sorts of jazz. So, the basics of a brokerage account. Here's how a brokerage account works. First, you're going to deposit your funds into the account. And brokerages may require a minimum balance of anywhere between about $500 to $2,000. So, generally, a good rule of thumb is that you should probably have at least $1,000 when you go to open an account. And then once you open your account, you're going to deposit your funds into a pool of money called a money market fund. And and your money's then just going to basically sit there until you buy or sell stock. And a money market fund is something similar to a savings account. So it's liquid, meaning it's readily available, and it's going to be there again until you're ready to buy or sell some stock. So the broker is then going to act as a middleman to executing your requested trade. And depending on the type of brokerage account that you get, the broker is typically going to make his or her money in one of two ways: an annual account fee or a nominal transaction fee. And these transaction fees are typically known as commissions, and they range between $5 to $10, but can run upwards of a couple $100 depending on the complexity of the transaction. And some brokerage firms actually offer free transactions depending on the firm. So the good news here is that you have a choice. You have a choice as to how much you want to pay based on what you're looking for in a brokerage firm. So there are three types of brokerage accounts. There's a traditional, there's the discounted, and then there's the hybrid, which is a combination of the discount and traditional brokerage account. And today I want to explore each one of these different types of accounts individually. The first type of brokerage account is considered traditional. And this would be, or examples would be Citigroup, Merrill Lynch, Morgan Stanley, Smith Barney. There are a variety of traditional brokerage accounts out in the marketplace. And these traditional firms tend to provide a wider range of services relative to those that discount brokerage accounts offer. So for example, in a traditional account, traditional brokerage firm, you might get one-on-one professional investment advice or specific research guidance or specific stock recommendations. And so the greatest difference here between the traditional and discount brokerages is that these traditional brokers are going to include a personal, or they're going to develop a personal relationship with the investor. And so an example of this might be that, again, you're going to get an individual financial assessment of your personal situation to help better determine your needs. Or the broker might put together a personalized investing plan that you get to review periodically, and you get to make adjustments, based on your risk and your time frame. But of course, with these personalized options come additional fees for these services. So the traditional brokerage service is really geared towards two kinds of people: those who either don't have the time or the interest to make their own investment decisions, or those who have larger asset profiles that they want professionally and personally managed. So you can think of a traditional broker, as someone who is similar to a money manager or a financial advisor, but it's important that we point out a couple other things to be aware of with traditional brokerage firms. The first is that, like we talked about, you can expect to pay higher fees as a result of these personalized investment guidances. Second is that there's no real guarantee that the broker or your financial advisor is actually going to be any better than you are at choosing investments. So don't necessarily equate expensive with the idea that you're going to generate greater earnings. On the flip side, however, with a traditional broker, because you have to execute all trades through somebody, then this broker may actually prevent you from making some really dumb financial decisions and losing a lot of money because, again, you're paying for that personal one on one relationship. It's also important, if you choose to go with a traditional brokerage account, to understand how your broker is compensated, because some full service traditional brokers may receive commissions every time they execute a trade for a client. And so, what this means is that their compensation package may be based upon how many times they buy and sell stocks. So if your broker is buying and selling a lot of stocks, it's important to understand if they're making that decision because it's the right decision or because he or she is able to earn more money on the additional trades. So it's always good to be cautious because unless you're very savvy about the in and outs of investing, it can sometimes be difficult to understand if you're getting good advice or if you're getting advice that's going to boost the commission package of your broker. The other thing I would add to the understanding the traditional brokerage account is that you typically can't execute a trade online on your own. You have to go through somebody else. So, if you're looking to place an order within 20 minutes, um, or an immediate order, it could be 20 minutes, it could be a day, depending on how quickly you're able to connect with your personal broker. On the flip side of the traditional brokerage account is the discounted brokerage account. And this is tailored more towards the do-it-yourself investor. So examples would be probably many that you've heard before. Charles Schwab, E-Trade, TD Ameritrade, Scottrade, Fidelity is another one that comes to mind. And these discounted brokerage firms have lower fees because they don't offer that personalized one-on-one relationship that you're getting with the traditional broker. Now, it's important to understand this does not mean that you're getting less information available to investor, because the discounted brokers are still, for the most part, going to provide the research reports and the other tools and information that you need in order to execute a trade or to understand what you're buying or selling. You're just not going to get the personalized relationship. So all those investment resources are online. You can read it, you can find it. You're not going to have a person there to discuss it with you. So the discount brokers often make more sense for the average investor because they're more affordable and they enable people to make their own financial decisions. If you're looking for a mix between the traditional and the discount broker, you might be able to find that via a hybrid account. And a hybrid account is where, for a fee, which is typically around 1% of your assets, you can meet with somebody, for example, once a quarter to go over your financial goals. And for some people, this could be a good compromise between a traditional and a discounted account. So I've listed a couple firms that offer hybrid accounts, and this screenshot at the bottom of the page here is actually just pulled from Charles Schwab's website, and it lists the typical fee structure and the minimum investments required. So if I could lead you with some concluding thoughts, I would say there are three. First is that it's important to understand that traditional brokers are going to provide you with one-on-one guidance. You're going to get attention, you're going to have someone and the same person to talk to about your decisions, but just know that this will generally cost you more to get that individual attention. Second, discount brokerages are going to be geared towards the do-it-yourself investor. So if you like to do your own research, if you're comfortable executing your own trades online, then you may want to look into a discount broker. And third and finally, if you invest in a traditional broker or decide to get a financial advisor, understand the whys and the hows going on behind the scenes. Because although you're not going to be executing the trades, it's still a good idea to ask why your broker may be making the recommendations that you're making, that he or she is making, and how it fits into the overall strategy. And of course, you're going to want to understand how the broker is compensated and how that might affect your overall portfolio.